Now, straight off, let's connect with Devin Choksi, Managing Director with KR Choksi. Devin, first let's talk about the trend. And the big trend on Monday was that money moved out of FMCG, money moved out of pharma, and that money went into high beta, namely metals, real estate, and PSU banks. So, what do you make of yesterday's weakness in HUL and ITC, in yesterday's strength in DLF and SBI? And do you think now it makes sense to sell defensives and buy high beta?
Yeah, good morning, Nikunj. Well, I think that would be, too early a call to probably get out completely out of the defensives. I would still think that the FMCG and pharma should hold at least 25% of your portfolio, if not more, in this kind of a trend. Because though I do agree that the slew of policy measures coupled with some of the actions taken in the European market and the American market in the last week for infusing the liquidity has resulted in a good amount of rally in markets across the globe and also in India. But it is still, I would still see that there are a lot of headwinds still ahead of us. Particularly, we have to settle down a lot on the political logjam that we have. We also have to settle down on getting started with some of the already logjammed projects which we have on the environmental names. So some of these issues would probably mean that the businesses would take time to get revived, and it would probably take at least couple of quarters before which you will see a real action happening on the business side. So given that kind of a possibility to expect a straight one side up as far as market is concerned, it would be far to expect, because it would even make the market valuation costly. So I would think that market would be a good buy opportunity at lower levels. Thus some of the high beta names which you are referring to probably should be bought in every fall, in every opportunity, so that when the market rallies thereafter, you get real advantage out of it. But getting out of completely from FMCG and pharma at this point of time, I would think that still you require some balancing of the portfolio. Thus wouldn't recommend to go all hog and probably capture the entire high beta stuff.
Even in the near term though, how much could a push or how much more headroom can the market see from the current levels of 5600 because of what we saw over the weekend?
See, we are typically in a 2009-10 kind of a situation wherein QE2 happened and the liquidity-driven markets also took place in subsequent period of time. We have the liquidity into the system, so it's easily assumed that the 10% upside from current levels in the market cannot be ruled out. However, 10% upside in the market without having a backup on the fundamental side, would be a dangerous proposition on the valuation. Thus, I would think that one will have to moderate the expectations to a greater extent. As of now, I believe that the market has the potential to go up. It could possibly go up close to 5800, 6000 levels for sure. Maybe thereafter it may have to take some amount of correction. But generally believing that the every fall would become a buy opportunity in this kind of environment. So 5500 should offer a good amount of support. So between 5500 and 6000 should be the range for the market going forward, at least for next 2 to 3 months.
Devin, why are you sounding bearish to me at a time when most cynical of the analysts have upgraded their price target for India? You're of the view that in the near term the best of the rally is behind us. That's not the Devin Choksi I know, because you've always been a bull in a bad market also.
No, Nikunj, I am not at all sounding bearish. Neither I am saying that the best of the rally is behind us. What I am trying to say is that in the near term you have certain amount of headwinds for which the market may correct to a certain extent, and that correction should be used as a buying opportunity. On the contrary, I believe that instead of tracking index alone, probably you should look at whole lot of stocks which are there in the markets, which are available for song right now, and valuations are quite cheap at this point of time. So considering that the market will have the potential to go up, maybe I sounded like saying that index levels would be this much, but within index many of the stocks have probably scaled up to a valuation level at which they are adequately priced currently. Unless huge amount of liquidity chase them, it is difficult for them to cross those valuation bars. My point was that buy in this market those stocks which are neglected, which are battered down, and where they have the potential and can go up very significantly. Some of the stocks are really available at a valuation which is far more lower than what their potential is. So from that point of view, I was suggesting that one will have to trade carefully on the index side, but individual stocks certainly one could select them and add them into the portfolio.
Give me an example of what is under-owned. Where do you think potential is high and markets are not, or that stock is not really capturing the true value?
Yes, Nikunj. I think in some of the infrastructure stocks, say for example, I'm not saying that I think you should buy all infrastructure stocks, but some of the infrastructure stocks where they have taken, I think, the leverage position quite under control, where I think the environmental related issues have stopped those companies, and where I think the possibility of environmental issues getting resolved in due course of time, I think those companies would get re-rated, and that could include some of the power generating companies. To my mind, I think the issues pertaining to power generating company is largely to do with the fuel supply and the power tariff hike. Suppose if these issues are resolved, and which is likely, then in such kind of a situation, some of the generating companies, say for example a company like Adani Power, which is available at around 40-45 levels, I think would have a upside, I think, to talk about. Similarly, I think some of the infrastructure finance companies, NBFC companies, which are available close to one-time price to book value, like REC, or for that matter IDFC, which is slightly above one-time price to book value, I think they would have a tendency to look up because of, I think, the valuation of inherent asset would start looking up. Banking stocks, for that matter, were quoting at around 1.25 to 1.5 times. Some of the good sized banks, I think like SBI, they would probably have a tendency to go up. So selectively, some of these companies certainly would have at least 25 to 30% upside going forward in coming times.
Even if one works with the assumption that in the near term government policy action is here to stay, so within the infra space, which is the first group which will be off the block first? Capital goods stocks because they are proxy to power sector, asset owners because they will survive and their balance sheet will revive if interest rates come down, or it's time to now buy builders?
No, builders I will keep out for some more time rather, because I think they are going to have the severe threat of, I think, inflationary pressure coming onto their profitability. So I would go, I think, slow on the builders. I'm not interested in buying builders at this point of time. But yes, I think the first two space, the capital goods space and I think the asset ownership space, where the interest would come. Within asset ownership space, I think the larger amount of interest would be for the port kind of an activity, where return on capital employed is always on a higher side, and particularly I think companies like Adani Port, where the things are reasonably looking good with the current price. So I think the company looks, I think, reasonably good from the investment point of view. So one can consider that company for investment portfolio. Even other asset ownership, though I am not in full favor of buying all the power generating assets, but even companies like Adani Port, where Adani Power, where I think you have a reasonable good amount of understanding on the subject, on the availability of coal, at the same time I think the power tariff hike possibilities. I think that could be one possibility, but as house I think we don't buy the power generation companies. Within the capital goods space, I think companies certainly which are looking more attention or likely to get more attention would be the ones I think which are in the transmission and distribution side of the equipment supply, and that is where I think you could possibly see some of the companies which are likely to get traction, including I think KEC International kind of companies would get some amount of traction. But our larger preference in that particular space would be the companies which are executing the transmission line projects like Sterlite Technology, which may be I think much better place compared to others. So I think we have selective choice within this particular segments of investments.
Devin, what about the FDI beneficiaries out of aviation and retail? Is there anything that you would still recommend a buy on with significant amount of upside?
Well, my larger confidence is not coming onto the aviation. The reasons are well known. I believe that though on one side you have given the opportunity for foreign players to participate into Indian equity in the aviation space, on the other side I think government has to do a lot in bringing down the cost structure for making the airline operations I think a smooth affair. The cost structure within the aviation space I think is so high that I think most of the foreign players may be very happy to get the civil aviation's permission to fly in and out of India, but I think not going on to, they may not be wanting I think very aggressively to get into the equity participation in some of these companies. So my reservation on the aviation space is largely to do with I think the cost structure under which they are operating. As far as the retail is concerned, certainly I think it demands more amount of close attention and a look at it. But again, I think which company you would buy within the space and which house you would select for that. I think the preference would remain with Reliance and Aditya Birla groups, I think, where they have got a larger amount of cash resources to deploy in case of I think the availability of the infrastructure to be created for the back-end purpose. So my choice would be to I think they stay with these companies. Unfortunately, both of these companies don't have a separate arm listed for I think the retail business. So I think we'll have to stay with the Reliance as a mainline investment, considering that they have a large retail portfolio in it.
So according to you, Reliance appreciated only because they have a retail portfolio. Is that the story for Reliance? Is that the story for Reliance now?
No, Nikunj, I think Reliance possibly, I think 2 or 3 reasons. I think from its core business, because of the improvement in the GRM and improvement in the margin in the petchem segment in this particular quarter has given the reason for the stock to go up. Second thing, approval of the capex coming in from the government side on the KG-D6, I think that has given the upside to the stock, and the possibility of, I think, they getting the price hike on the KG-D6 production, that has also, I think, re-rated the stock. To my mind, I think what one has to understand is the amount of exploration potential that they have and vis-a-vis what they are producing. If they end up getting, I think, higher amount of production somewhere down the line, then possibly I think the stock has a reason to get re-rated further. Of course, the retail and the telecom portfolio within Reliance, I think, demands a close look at it because of, I think, the growth that it assumes going forward and the kind of valuation that it can attract going forward. So one of the reasons could be, I think, the stock moving up is also, I think, the large retail portfolio that they are carrying into the balance sheet.
Prospects of Reliance Industries, that if someone has completely missed the move on Reliance at 864, is it still a buy call?
Well, I think it's not, I think, the case of, I think, miss the move completely, because of course I think we have seen 700 recently or 720 recently, but still I would think that the potential of this company is far more larger. You have 5 main business lines, I think, within the company, and those 5 business lines, I think, include the high growth areas in retail as well as, I think, the data communication through telecom. I think these 2 areas, I think, have the potential to significantly ramp up the business of Reliance in subsequent period of time. And those who are looking at, I think, buying this company for next 5 years, I think for them, any small dip or correction in the market could be, I think, a buy opportunity into this stock. It's futile to set the price target as to what level you should be buying, but to my mind, I think if you are a long-term investor and looking at, I think, around 2 to 3 times appreciation in this stocks over next 5 years time, then I think any fall in the market price could possibly be a good buy opportunity on Reliance.
In your personal portfolio, Devin Choksi, if you had the option to buy Reliance Industries, would you buy at 800, would you buy at 860, or would you buy it below, at sub 800?
Yeah, Nikunj, I am already invested in Reliance, so I think anything which is closer to 800 in current situation, I think would be a good buy opportunity. Earlier days, I think I used to keep that opportunity somewhere around at 750 levels, at which I think I have accumulated the stock. So around 800 in current situation would be, I think, a good buy opportunity for Reliance.